According to the author, there are two types of intelligent investors: enterprising investors and defensive investors. Enterprising investors aim to beat the market by discovering and purchasing highly undervalued stocks, while defensive investors settle for matching the market by diversifying. This is one of the best and most practical books about investments written. In order to beat the market, enterprising investors must be smarter and better informed than the vast majority of their competitors. If someone without the requisite skills and knowledge attempts to beat the market average, they're likely to perform worse than the market average. Thus, the vast majority of us would be wise to settle for the stock market's approximate 10% average annual return. In The Intelligent Investor by Benjamin Graham, investment is also specifically mentioned to be different from trading or speculating. Some may call it fundamental investing, and what it means is just that one must study the company's fundamentals, financials, management, before selecting it for investment. Normally the investment would be long-term, and the only time to sell is if the company's direction or management does not fit with investors' requirements anymore. Lastly, The Intelligent Investor by Benjamin Graham introduces the concept of margin of safety. Of course, the writer puts this concept in context of the Great Depression of the 1930s. The idea is that even if a stock looks cheap on paper, you still can get screwed by the irrational Mr. Market who prices it lower and lower. So a stock that looks borderline cheap is not good enough. Ben Graham recommends to have a bigger margin of safety and buy it really cheap. It will help with the sleeping soundly at night too. It is the result of living through the Great Depression, and it is a lowering of one's risk to the point where the returns will be quite limited too. Graham's investment philosophy is anchored around the concept of margin of safety. Past behavior of the company is the best available predictor of its future results, and thus returns on investment. Not a good script for a high-risk speculative investment, which Graham calls exactly that: speculation, not investment. In particular, I liked the focus on some physiological pitfalls an investor can encounter. For example, the home bias, investing in what I know, can be dangerous, since it makes me as an investor lazy and complacent. Or discussion on the role of Mr. Market, who comes to you every now and then and recommends what your business must be worth or what you should sell it for. An intelligent investor should never buy a stock because it has gone up or sell one because it has gone down.